Hi, I'm Victor, and welcome to my live stream. I really appreciate everybody that's been joining the live streams. I also appreciate everyone that's been watching the videos that I put on my channel, and I really appreciate all the comments that people have been putting on my videos. I really appreciate the support, the feedback, the ideas, the collaboration. That's awesome. Thanks so much. And I'll continue to put my best effort into videos that are produced. In today's live stream, we're going to go over how to create a good stock portfolio and kind of go through a stream of thought on how to do so. As we get started, let me just remind everybody that I'm an individual investor, just sharing my journey as an investor and sharing what I've learned and passing that along. I've learned a ton on YouTube as well as from books, from listening to other investors. And everything that I say is for educational and entertainment purposes only. I'm not providing any financial advice, and I'm not making any recommendations to buy or sell any of the stocks that I cover. It's just for your consumption, and I hope you find it interesting. As we get started, thanks so much, NK, for sending a message. I know I'm starting the live stream at 3 p.m. Pacific. I live in California. I'm in Pacific time zone. So sorry that I started, I guess, so late in your day. I think it's 1 in the morning where you reside. And hopefully I can do a live stream earlier in the day that you can attend. And then another comment looks like Lynn Samuel. She couldn't make it. Really appreciate you sending the message. I've noticed that you've attended live streams and also commented on videos. I really appreciate the comments that you've provided. Please keep them coming. You've asked some really good questions, and hopefully I addressed them correctly. So thanks a lot. Appreciate it. So it looks like I have a few people attending the live stream. Thanks so much. I'm going to get started on just some fundamentals on how to create a stock portfolio. Please ask any question you'd like. Maybe for the first section, we could keep it to creating a stock portfolio. You can ask any question, meaning, hey, let's take a look at a stock. And I will definitely do that, but I'll do it once I get done kind of talking through the flow of creating a stock portfolio. So if you think of it, just put it in the comments and I'll get to it. So thanks so much for attending. So as I communicate with people that watch my videos and attend the live streams, a few people have asked, hey, is there any way I could get better at creating a better stock portfolio? And some people, it seems like they're new to investing, and some people are probably a little more of a veteran. In any case, I think always going back and revisiting maybe some ideas and principles behind creating a good stock portfolio is a good idea. Whether you're just starting out, hey, how do I create it? What do I want it to look like eventually as I work on it? And maybe if you're a veteran investor, hey, I've got my portfolio, but let me look at this example and see if I can learn something. So hopefully it's good for everyone that's attending. Got a quick comment here from Ian Gantner. Good afternoon, Victor. I'm a recent subscriber. Been enjoying your channel. Just saw a notification. Hey, thanks for checking in, Ian. Really appreciate you joining. And thanks for watching videos. So let's get into a portfolio. So first and foremost, investing is a very personalized, craft. You're personalizing where you're putting your hard-earned money, the money that really means a lot to you, your family, and putting it, what you think is to the best use, where you're going to get the best return at the rate of risk that you're willing to take. So as we look at a portfolio, based on your age, there's going to be different, or I should say, there's going to be a different perspective on how you're going to address risk and rate of return. In investing, it's always about everybody wants the best rate of return. But the thing that comes into play is risk. If you're maybe older, I'm 55. If you're 55 or 65 or 75, and you're like, hey, I've been in the stock market for decades, and I just want to make sure that I've got plenty of money in the next 10 years, 20 years, you're probably going to want to take some risk off the table and put some of your investments into lower risk. That's where you balance risk and rate of return. Because even as recent as 2022, stocks really had a big downturn. The NASDAQ was down close to 40%. The S&P was down, I think, mid to high 20%. So you could see that if you were all in stocks, you'd lose quite a bit in a year like that. But if you're young and have 30 years to invest, you can take a bad year followed by a couple of good years, you end up ahead. So as I look at some of the things that I wanted to pass along, first area is, you have different classes of investments. Stocks probably are, in my opinion, more interesting because there's a company behind them, a company like Airbnb that does vacation rentals. And I get to really understand that business. And you buy a stock, you're buying a fraction of that business. A bond is far simpler, but it's far less risk. A company is saying, lend me, as an example, $1,000, and I will give you that $1,000 back, and I'll pay you a rate of return of 6%, 8%. So as an investor, you're like, hey, that's an investment that's pretty simple. In essence, lending money to a corporation or a government entity, or even the U.S. government when you buy U.S. issued bonds. So stocks are very interesting, harder to value, much more involved decisions. Bonds are simpler. You also look at the quality of a bond. It may be a very high quality. Let's say a Johnson & Johnson or an Apple. They have very high quality credit ratings. Then you can go down the credit rating. So there's stocks, and then there's bonds. And what's become a pretty popular investment is cash. And Warren Buffett, he's having his annual meeting with Berkshire Hathaway, and he has like over $100 billion in cash. Now, cash is earning 4 to 5%, in money market accounts. That isn't all that bad. If you consider we had a great 2023, we had really good gains, and Warren Buffett sold 13% of his stake in Apple. As an example, he made a lot of money on Apple. And I think he's satisfied putting some of his investment in cash. So just to go over asset allocation, you have different choices in different types of investments. Now, going one step further, so I'm going to put myself in the shoes of a new investor. Okay, hey, I started working. I got, my career off the ground. I'm beginning to make some money. Maybe I have $10,000, ready to invest, and then I can invest $1,000 a month. Where do I start? So first is, age, I think, does have a good factor, because when you're, let's say, 30 years old, you likely have your career ahead of you, or if you're an entrepreneur, you started a company and you're going to make that company work, and you're going to have your best earning years ahead of you. So for an investor of that type, most investors that are 30, 35 years old, they don't need the money that's going to be invested for 20, 30, 40 years. With that type of long-term horizon, you can be completely in stocks. You wouldn't be taking too much risk. Now, you can put some in bonds, but I think we're getting to a point where bonds are paying quite well, especially if you look at some corporate bonds that are a B-rated bond. They pay upwards of 10%. So I could see higher yield bonds making it into a portfolio for a 35-year-old. But I would say that this is issued out by financialsamurai.com. I don't endorse them. I thought they had a good visual that I could work off of. But I think this gives us kind of a good framework. As an investor, has a higher age, let's say between 40 and 50, that's where you do begin to say, hey, let me take some risk off the table. And if anything, let me begin to learn how to do fixed income. Because once you enter, let's say 55 to 65, it becomes more important. Maybe you're deciding, hey, I'd like to retire early. I'd like to retire at 58, 60, 62. In order to do so, I want to make sure that I have all my living expenses taken care of through my investments. And that's, very possible. As you enter that age, you want more in bonds, which is, in other words, called fixed income. When you hear fixed income, people are talking about bonds because remember how I described them. They have a very simple structure. You're lending a corporation, as an example, $1,000 for 2 years, and in 2 years they return $1,000 back to you, along with a 7% interest rate, and they call that a coupon rate. So as you get older, you start buying more bonds, and it also depends on how much money you have. If you have $100 million, you're probably going to invest different than if you had $500,000. I think an investor would have to really make decisions around, what is my cost of living? How much do I want out of my portfolio, and really create a nice budget there. So we talked about different asset classes, stocks, bonds, and then cash. And now we got to look at age, because some of the questions coming, through the live stream, it seems like some people are investing for the first time, but the ages kind of vary. So I wanted to put that out there and say, think about age and think about when you're going to want that money, or when you imagine you're going to need that money. Okay, so you've decided, okay, I want to invest, and I've got $10,000 as an example, and then I want to put $1,000 in the market each month. What else do I need to consider? Well, if you invested in one stock, that becomes really risky. And I remember hearing the stories of Enron. I don't know if people have heard of that company, Enron. It's now bankrupt. It was a pretty famous stock that really imploded. And unfortunately, a lot of people had like their life savings in one stock, Enron, a lot of the employees. And that's an example where people were not diversified, and that really hurt them, because the one stock they owned was Enron. They didn't get out, and they lost their life savings. So it becomes really risky. If you have, one stock and you're 25, you might be okay, but it's still really risky. You want to diversify, if anything, across a couple of stocks. And, if you look at, the classic advice, or what advice should be given in textbooks, and, from the I think the internet, you would see that people recommend, well, have stocks, have some bonds and some cash, and have a variety of stocks, and have a variety of bonds and some cash. And I think that's good advice. I think that variety, and I should say diversification, is a way to lower risk. And some real life examples over the last 2 weeks. So I own Meta. It's where I own the most stock. And I can't pull it up at the second, but it's upwards of a $200,000 position in Meta. And in one day, it went down 11%. So it was not a fun day. It went down a lot of money. And the very next day, Alphabet reported. That's my second or third biggest investment, and they had very good earnings, and they went up upwards of 10%. So one day I lost big, the next day I gained big. So that's diversification. One stock may be going down, another one comes up. My intent year to year is to see my investments go up in value and generate income through the form of dividends and interest. So if I can look at the last 10 years and say, okay, great, I made more money in 2023 than my wife and I would have needed. And the year before, 22 was a tough year. I lost money in my growth fund along with everybody else. My income fund did really well compared to the S&P. And my bonds did very well because bonds really stand up when stocks go down. But I can then measure year to year, how much am I making? And with a diversified portfolio, which I'll show you later, how I'm diversified, you really are taking a lot of risk away from one stock having a really bad quarter, a really bad year, or, you look at the example of 3M. 3M is an excellent company. They've been an excellent company for like 50 years. That's not an exaggeration. They're an awesome company. And they made earplugs that failed in service, and a lot of servicemen and women lost their hearing. So they were dealing with this huge lawsuit. And then they had another lawsuit, and I forgot the reasons why, but I know it was big. So fairly quickly, that one company that was a trusted brand, still is, great company. They didn't mean to hurt people, facing these multi-billion-dollar like lawsuits that could have potentially really ruined the company. And that one stock went down in value very fast. It was a very trusted stock. So if you had all your investments in 3M, you'd be in a lot of trouble, a lot of hurt. So that's why diversification is suggested, recommended, and I believe in it. So now it's always about getting quality. And I'll get to that later, but let me end there on diversification. So again, back to this new investor. Okay, great. $10,000. I can invest $1,000 a month. Where do I start? Right. And I've probably said this a few times to this point, and I'll say it probably 1,000 times in the future. Always invest in stocks that you can understand. And where possible, invest in sectors. Each one of these yellow boxes is a sector. You have the energy sector. Within the energy sector are industries that map to that sector. For example, oil and gas companies. Energy also has power generation companies like utilities. So those types of companies live in that sector. Consumer services, communication services, is where Meta, Alphabet, Netflix, Comcast, Disney, as well as AT&T, T-Mobile, that's where they exist. There's multiple industries there. So where I would say to that new investor is start where you have experiences that map to one of these sectors. And I'll give you kind of a real life example for me. I worked at a pharmaceutical device company. I was an accountant. I was a controller with a company, and we made a pharmaceutical device. We had to go through FDA approvals and so forth. And that experience enables me to understand pharmaceutical companies, which is an industry within healthcare. So if I was a brand new investor and I had that experience with a pharmaceutical device company, hey, I should start in healthcare and look at companies that I'm familiar with because I worked at one for 4 years. And I know their financials because I used to prepare the financials. Or you could have been a sales executive or rep. You could have been in marketing, whatever. But if you know that industry from first-hand experience, that's an advantage you have as an investor. A lot of people have to go to a sector because they want to diversify. They don't have any first-hand experience. Well, you have an advantage there. So start where you have an advantage. So this new investor could start in healthcare and start investigating companies, researching them, seeing which one he or she believes is the best one in a particular category. So the number of companies on the stock market is very, very large. And the amount of information is immense. There's no way one person can cover everything there is to know. So again, the quickest, or I should say, I would encourage you to think about where is it that I have that information or knowledge or passion advantage where I'm really interested in a sector of industries like healthcare, where I can really sink my teeth in and have some real life experience that's going to help me understand those companies. So we're assembling a portfolio. We're thinking, okay, we want to buy quality companies. We want to have some diversification. We're going to get started in sectors that have industries that are familiar to the investor, and kind of sink your teeth into those types of companies. Once you're to that point, it's really, there's one thing I wanted to share is, sometimes when you want to start investing, you want to, you've heard of the expression, go big or go home, right? You're eager to get in there and start investing and really mix it up. And I want to caution you on that. Be eager to learn, be eager to research, be eager to listen to people on YouTube, be eager to listen to earnings calls from a company, because learning is free. You lose no money on learning, but you can lose money on investing, right? So be eager to learn and advance your skill set and advance kind of like your frame of reference around investing. But be cautious in investing. Once you start putting your money, into a stock or a bond, be cautious. Double check, triple check. Your logic is there, especially as you get started. Getting started is a lot easier than it used to be. We used to have to pay, $25, $30 per trade, to buy a stock. It was a different, level of involvement and cost. Now we have zero cost trades. You can buy a stock and sell it 5 minutes later, and there is no cost to it, and you can get in and out. If the market's open, it's very easy to get in and out. So be eager to learn, be eager to just keep learning and getting better. And just be careful when you invest is another thing that I would put out there. All right. Got a couple of comments to catch up on. Okay, great. So you're heavily investing in Medtronic. That's a healthcare, the med device company, I believe. And we're going to cover Medtronic in a few minutes. That's a good one. I've looked at it in the past. I haven't looked at it in a long time. So that's a good one. Thank you, Ian. I'll take a look at that. And then Omar. Thanks for joining, Omar. Learning has cost me a lot of money. Yeah. And I think you're kind of reinforcing something I just shared, which is, investing as a, when you decide, hey, I'm going to start saving my money and investing it because I want to grow it. Maybe you had somebody, in your life, a parent, somebody in your community that did really well with investing. And you're like, I'd like to accomplish something similar like that. That's great. That's awesome. You've got the internet, you've got YouTube, you can do it. I'm here to tell you that you'll learn. If you learn every week, if you commit to learning, you're going to be a good investor. You're going to find, whatever areas you've worked in, you're going to have expertise in that sector, and you'll keep getting better. But be eager to learn and be careful when you invest. If you had $10,000, would I say, oh yeah, invest it all on day one? No. investigate companies, and then start a position where you want to start a position like with a $10,000 fund. And this is a little realistic because I have a 24-year-old son, and his portfolio of stocks is like $21,000. And he started with $10,000. So we weren't diving in, with a $5,000 investment on a stock. No, we were more like $200 and then increasing it by $100. He owns roughly about 15 different stocks, all growth stocks. He just turned 24 on May 2nd. So he's got 30, 40 years before he'll ever touch that money. So be eager to learn. Be careful when you start putting money on stocks. Okay. So, and a portfolio doesn't have to be like 100 stocks, and because that becomes kind of heavy to manage. It could be 5, it could be 10 when you're getting started. Just the one thing that I would also really encourage is have a routine of measuring your performance. Hey, how did I do in April? I go through a routine. I look at, how did I do from an appreciation standpoint? How much did I do year to date, last 3 months, last 12 months? How much dividend income did I generate in last month, last 3 months, year to date, last 12 months? And what I'm trying to assess is, how's my portfolio performing? And I also look at individual stocks, and I do something similar, which is what's the year-to-date change in the stock? How am I doing in each position? So that way I kind of have a good sense of, what's the value of my portfolio. And each year I want to be growing my portfolio probably about 10% overall. And that's a pretty lofty goal because I've been doing it for a while. But it's really fun to grow it by another 10%. And that 10% represents more money than I need to live off of for my wife and I, and then some. So put in a routine of each month, you're going to look at your portfolio, you're going to look at the stocks, see how they did, and look at it from a broader like timeline, last 3 months, year to date, last 12 months, just to see what kind of trends you're seeing in your stocks and your portfolio. So, and the next thing is, go back and learn more. So you go through a whole cycle of a month, and it'll probably tell you what you probably can learn more about. Maybe you're really good at healthcare, or I should say you have a good starting point with healthcare, but you also want to invest in some financial, sector companies. And you're like, hey, I'm looking at PayPal, or I'm looking at this, or I'm looking at that. Great. Go learn some more there, because that'll give you an opportunity to diversify, not just healthcare stocks. Maybe you can buy some financial stocks and maybe just keep growing and making yourself more capable as an investor. Okay. So that's kind of like the flow of creating a portfolio. I mean, we could talk about managing a portfolio, creating a portfolio, improving a portfolio for hours. And what we could do is, I'll have live streams, and we can, talk about portfolio management maybe once a quarter. And we'll start off with, speaking to all parties. If you're new, if you've been doing it a while, I hope that I could speak to everyone and add value. Okay. So just a quick tour of how I've diversified, and then we'll jump on Medtronic. So Ian, thanks for being patient. So I've diversified into companies that I feel I can really understand, like Netflix. I've been an investor, and although I've only got $11,000 invested right now, at one point I had upwards of $60,000 invested, and I did really well, and I sold most of that position. But I've got a lot of money in communication services. I think the total is a pretty good number. Let's see here. I think I was doing that wrong. Yeah. So I got a pretty good number in communication services, the biggest being Meta. And this is the biggest sector that I'm in. I really understand Meta. I really love their business. If you look at their free cash flow, I've been an Alphabet holder for some time, and I've been known of Alphabet since they started as Google. So I know those companies quite well, and Comcast. So that's a sector I'm really in. Some sectors like discretionary are really, I find them more difficult because the companies are very different. Like Nike is very different than Ford, which is very different than Starbucks, very different than a retailer. But communication services companies, once you look at their financials, they're very similar. They don't make anything. They just pretty much are getting they're providing a service, a marketing service, an advertising service, and then they make a very good margin. So I'm into some discretionary companies, but not as much. I find them a little harder to invest in. It's not my core competency. So I've got some money there, but not a whole lot. I have some consumer staples, Kroger being the biggest position, and then a couple of small ones. Consumer staples haven't been doing all that great. You know, they're nice, steady stocks, but not that great. I have a sizable investment in Chevron, and I worked at Chevron a long time ago, so I have a good investment in Chevron. Financial services and financials overall, I have a lot of investment in, and the reason for it is that in 23 it was really discounted, so I started buying into like PayPal. Robinhood has been a winner, and Citigroup, US Bank, Ally Financial. And I've really diversified within that particular sector, and it's gone really well. From a percentage standpoint, Coinbase is number one, but I didn't put as much money into Coinbase as, let's say, a Meta or an Alphabet. Healthcare, I think, is going to really rebound in 2024. And I've got money in small companies within healthcare that I think are pretty exciting, like United Therapeutics. If you see what they're doing, it's pretty incredible. Harmony's been having a couple of good weeks. Catalyst was doing great, but for some reason they've kind of fallen back a little bit. And I've got Pfizer, CVS, Cigna, and Elevance. So that's how I diversify. And I'm not going to go through the whole list of sectors, but it takes years to kind of get to a portfolio where you feel like, okay, I really know these companies. I know, which ones I really want to hold forever, like a Meta, an Alphabet, a Chevron. I even feel that way about Ford because they're just a good run company, and then you build your portfolio. So, all right. So now we want to analyze Medtronic. All right, Ian, thanks for being patient, and keep the comments coming, please. Okay. So let me get my analysis tool. So Medtronic develops, manufactures, sells device-based medical therapies to healthcare systems, physicians, clinicians, patients worldwide. Its cardiovascular portfolio segment offers implantable cardiac pacemakers, cardioverter defibrillators, cardiac resynchronization therapy devices. Okay, so it's a medical device company selling these products so that people, I imagine, can live a better life because they have a heart condition. Over the past year, they're down 9%. Looks like they had a really rough October. Year to date, they're down just a slight bit, about 5%. And it's a 3.38% dividend payer. It's a pretty good size market cap at 108 billion. All right. So they received FDA approval. Spinal cord stimulator. I don't know what the total addressable market is for this. That'd be interesting to take a look at, Ian. If this is like a game changer, like, oh man, this is going to be a $1 billion of revenue for them, then that's really interesting. But if it's just going to be like, $5 million a year, it's great that they're going to help all these people, but it's not a big revenue line. All right. And when do they announce earnings? They're going to announce earnings on the 23rd. All right. Looking at their revenue, I'm looking at their financials, and this is their income statement. Looks like they have had some growth years, and it's low growth, right? 17, 3%, 18, less than 1%, 19, 2%, minus 5% in 2020. That was probably COVID related. So give them a pass on that. 4% on 21, 22, 5%. And then they had a down year in 23. And that's probably why we've seen that stock price really take a hit. All right. So revenue has been, we're hoping that it rebounds, but it's reality that it was a down year last year. Cash flow, cash from operations has been good. Looks like they had about 4.5 billion, 4.6 billion in free cash flow in 23, which is 6 billion minus 1.4 billion gives us about 4.6 billion. And the year before that, they had 6 billion. Year before that, they had in the neighborhood of 5 billion. So it's been a consistent high free cash flow generator. Okay, that's good. And if we multiply 4.6 billion times 20, it gives us roughly 92 billion. They have a market cap of 108 billion. So it's probably priced around where it should be, fairly priced. Looking at their forecast, analysts, there's 12 analysts that are looking at the stock, and they have a buy rating with saying that the stock is discounted by 16%. If we look at earnings per share for 24, it's expected to be $5.25. And it's going to grow. It's going to grow nicely. Almost 5% in 25, 7% in 26, 8% in 27, and so forth. So earnings per share looks good. All right. Dividend payout ratio is a little high. It might be because they had that down year. If they're rebounding, then I would be interested in seeing that. This is probably going to be fairly priced. The next earnings is probably going to tell us a lot about, hey, are they going to start growing, or are they going to, have additional losses of revenue? They don't lose a whole lot of revenue, but looks like the last quarter close was on January 26, 2024. They did have growth. That's good. I'm looking at quarterly now. I'm looking at their income statement. And instead of looking annually, I'm looking at it quarterly. And it looks like they grew 4%. That's a very good sign. That's very good. If we look at cash flow is very good. More than $2 billion of cash flow in that quarter. Yeah, so I think this is going to probably be fairly priced or offer a small discount on Medtronic. So I would, if you really like the business and you think, hey, these guys are going to grow, they're going to be bigger, they're going to bounce back, that might be a good investment. You can see that the stock price is really down from 2021. It was up around $134 a share. Now it's at 84. So it's really come down. Might be a good discounted stock. Good luck with that one, Ian. Appreciate you asking the question. All right. So please suggest any company you want to talk about or any other questions you have on a portfolio. Since we have a little more time, I wanted to cover a couple more sections around, creating a portfolio. So you're an investor and you're like, okay, well, how can I find, information on stocks, sectors, industries? Well, I really like stock analysis. Okay. This is stockanalysis.com. They don't sponsor me. I pay $10 a month to have this service. You don't have to pay anything, by the way. You can go to their website and get everything except for one thing that I'm going to show you for free. And I like how their website's set up. And they got really good information. And they have a good stock screener. A stock screener allows you to look at a sector, healthcare, where I can look at financials. I've got this number of companies there, technology, industrials. I can look at any sector. I'm going to look at financials. And then once we're looking at financials, we could say, hey, I want only financial companies that are making over 5% free cash flow growth. Okay. But I could, put any criteria I put in there. I could say free cash flow grew 10%, 20%. Free cash flow is a very key metric. So that's why I put it in there. Forward PE. We want the lowest forward PE possible. That way we feel like, hey, if they start growing their PE, it's going to expand their stock price and we see great appreciation. So under 15. Debt to EBITDA is important. I want it under 3. And all these this is a free stock screener. So you can go to stockanalysis.com and work on it. Free cash flow yield over 5% and earnings yield over 3%. And it gave me this list. Johnson & Johnson is there. And it's kind of interesting that Ian asked about a med device company, right? Because that's what I'm talking about here. Med device is in the healthcare sector. It's one industry within healthcare. But this is a good place to kind of sink your teeth into these companies and see if you like it. Let's dive into J&J. So J&J has seen its stock come down. J&J was like the Apple of, healthcare. They were really respected, and they've had a couple problems. I think they were sued over their talc, and they've had a couple problems. So their stock price is down. Is it an opportunity to buy this really high quality company? It's a huge market cap, 359 billion market cap. And you can go through and investigate it and see, hey, I understand healthcare. I'm a new investor. Is this the right type of investment? You don't get hurt when you're building a portfolio. The bigger the company, I would say the more reliable, because their information's more reliable. There's more investors that believe in the company. It's a more known, company like Johnson & Johnson. Everybody knows them. Whereas if you go small companies, you can lose very quickly. And the reason for it is people don't know it. So they're like, oh, tiny companies, I'm not ready to invest in those, because if they start reporting bad news, the stock price usually really goes down fast. But J&J is given, I think some runway to kind of repair their business. So that's J&J. You can look at, that was the biggest market cap, but Insight is up there. These are smaller companies. Here's Harmony. I think I showed you Harmony earlier in my portfolio. Catalyst is in my portfolio. And here's a couple others. So you're building a portfolio. You can start using some of these tools like a stock screener. So you can, dive into an industry that you really like and start picking out some companies that you can analyze. Some of the, sectors, just to give you, a sector is made up of industries. Here's communication services, internet and content information. That's where Meta, Alphabet are. Telecom services, AT&T, T-Mobile. Entertainment, Comcast, Disney. Advertising agencies, electronic gaming and multimedia. So this is like Roblox or electronic arts. Broadcasting, this is like the old TV stations. Publishing, old publishing companies, which these companies are really hurting. That's why they're listed last. So you can see these are industries within a sector, and you can go through and say, hey, where do I have experiences? Like, hey, for travel, hey, I worked at a, XYZ, and it gives me that information advantage. So you can go through and pick out some industries that you can be good at. Let's say you worked, like I mentioned, I did oil and gas. I worked a job, doing oil and gas, and it was an integrated oil company. So I have experience in exploration, refining, and marketing, and these not so much. Like midstream, these are different animals, and then drilling is a different animal. So that's where you can search for additional ideas. And the last place to look for good ideas to build a portfolio is Stock Analysis. Does a nice job of what they do is they aggregate like analysts, like Stock Analysis. The reason I like them is if you go to like a CNBC, you got you got a lot of things going on, and they don't have a very good stock screener. Or if you go to Yahoo, it's even worse in my opinion. But it's not an opinion live stream, but you can see that it's pretty active here. I'm just trying to get, business news, and I'm getting a lot of, if anything, distractions. And I like how it's put together, just really simple. And this is on the paid service. They will give you the top 50 stocks to take a look at based on analysts and the rating they have and the amount of discount that they're putting out there. They're saying that Zscaler is discounted by 29%. And I sorted on the analyst count because we can go down to, like, if it's one analyst or just a couple, and they're saying, oh yeah, this thing's, 4 analysts are saying it's 50% discounted. Well, that's great, but I'd rather listen to 24. So then you can go into Zscaler. What's it been doing? Okay, the stock's been down, now it's been up, now down. Zscaler operates cloud security. Very good. $26 billion market cap. I've heard of Zscaler. Forward P is 64. Of course, price targets are 28% higher. They're going to announce earnings on the 30th. They've been growing their business tremendously. Holy smokes. 59% growth. And they're kind of small. It's easy to grow really fast when you're small, but it's still really good growth. $1.6 billion company. Excellent. And are they profitable? No, they lost money in 23. I don't think they have their first quarter out. Well, their quarter that ended January 31st is out. They grew 35%, and they were not profitable yet. All right, cash flow. So they have operating cash flow of 142 million. You deduct the 41 million of capital expense, and you have about 100 million in free cash flow. And the year before, they were at 224 million for 23. And this is fiscal year. The fiscal year ended January 31st. Fiscal year ended, I'm sorry. I'm looking at quarterly. Got it wrong. Scratch that. Free cash flow for 23 is 462 minus 128. So that is going to be about 334 million. Year before that was about 230. Very good. So you see that upward trend on free cash flow. Very good to see. This is looking like a good stock, Zscaler. So we got good growing cash flow. The cash flow is at about 300 and okay, good. The forecasting 28% increase. So this is a very good stock to look at. And I looked it up using, their recommended. Now, you could probably get 100 lists of recommended stocks online. So really trust your source. Again, I like Stock Analysis. They don't have a whole lot of things like that they're pushing. They're just a good information site. So that's why I like using them. So I'm going to do a deep dive on Zscaler. Let's see if we can do a quick valuation. Okay, so if you watch my videos or you attended the other live streams, this is a spreadsheet that I have. I've created these formulas. This is my valuation model. And I'm going to create one real quick for Zscaler. All right, so ZS is a symbol. ZS is a symbol. Zscaler. This is a smaller company. It was a $1.6 billion company. So I tend to, treat companies that are smaller as riskier. So instead of being 9% discount rate, I'm going to go to 10%. Okay. And they've been growing really well. So their last, let's go back to their free cash flow. Their free cash flow is 462 minus 128. So we'll put that in here. That's going to be our starting point. This is free cash flow for 23. That's fine. And the cash flow is growing very dynamically. You see that? You got 36%, 154, 59, 40. Wow. Man, these guys are growing. That is awesome. So first 4 years, I'm going to grow at 25%. Then after that, I'm going to grow at 4%. Okay. So my estimate here, I'm going to grow this number by 25% because this is last year, right? And they're growing dynamically. So, all right. So the intrinsic value of all the cash flows is 10 billion. The cash flow on the balance sheet is 2.1 billion. So I'll put that in here. And then total debt. So long-term debt's 1,176,000,000. Any short-term debt, current debt 34 million. So all right. So we get an equity value of all those cash flows is 11.5 billion. And when we look at the market cap, it's 26.54. So it's really still overpriced. Shares outstanding 149.86. Value per share $76, 177.11. All right. So the free cash flow method's not looking good, not even close. I'd have to get really extreme on my growth rates. Maybe I could grow this value, but I hate doing that because, you know, these small companies, right? This is great. But what if Microsoft added a feature to their software and all of a sudden they provide something that Zscaler sells, but they provide it for free, or Google or Apple, or these big, massive companies can add a feature set that just completely destroys the Zscaler business. So I don't want to get over, way ahead of myself on that growth rate. So on the forecast, their earnings per share for 24 is 285. I want to make sure I get the right number. Next year. Okay. So 285. And the PE, I am going to give them like a 36. This is high growth. And then the growth rate is looking good on the growth rate of earnings per share. It's supposed to grow very fast. So, okay. 20% there. But even with those numbers, we're still at a deficit. It's selling at a premium of 50% if we look at free cash flows and 30% if we look at earnings per share. So the Zscaler looked really good on paper, but it's so small that it cannot substantiate that big market cap that it has. So there we just ran through a quick valuation of Zscaler. All right, good stuff. So that kind of put a additional information on, portfolio creation and looking at companies. Any other questions that you guys would like to go over? All right. So, yeah. All right. So just to kind of, I guess, wrap things up. I'll come back to this slide. It's every investor's got like their situation, and you got your preferences. Are you a high risk, type of investor, low risk? You like smooth versus pretty volatile, but over time you make a greater return. And those are the decisions, you make. You don't have to make them and then stay with those decisions forever. Every year you can adjust. You can continue to learn more about yourself, what you like, dislike, what stocks you really like, what industries you really like, and become better at it. So it's not something you're going to set in stone and say, okay, I can only invest this much in stocks and this much in bonds, or I can only invest in 10 stocks. No, that could just continue to evolve, and you make it what you need it to be based on what you want to do. So good. So if there's no other questions, what I'll do is I will wrap up the live stream. Thanks so much for joining. I really appreciate it. And hopefully, I know that a couple people asked about creating a portfolio, any guidance or lessons that are possible. And I hope this really speaks to those investors that tune into my channel. Everybody, thanks so much for joining. Everybody have a good night and good luck investing.